So common sense tells us we look at seasonality, we look at where speculators are positioned, we look at what the history of coffee prices are, and we use that to dictate how much we should hedge and how little we should hedge and proceed accordingly. And that doesn't mean we're right. That doesn't mean all of the analysis and all the smart people in the room aren't going to be able to figure out where coffee's going, but you have to basically play the odds.
This episode is proudly brought to you by Mapper Forward's workshop, It's Time to Become a Coffee Consultant. Learn how to diversify your revenue streams and create freedom from your day job while saying goodbye to that alarm clock forever by becoming a consultant within the coffee industry or directly to consumers who have shifted towards home brewing and home roasting. Protect your income from challenging times in the coffee value chain by taking this course today. Go to mapperforward.coffee/workshops or click the link in the show notes for details. Welcome to the Daily Coffee Pro by Mapper Forward, friends. I'm your host, Lee Safar, and this is episode 3 of a 5-part series with Carley Garner from DeCarley Trading, and we are talking about the volatility in coffee pricing, specifically on the futures market, the ICE exchange, or the C market as we call it in the industry. And given that we're having this conversation about price volatility, we can't have that without a semi-deep dive on hedging. And so this episode is going to be about the role that hedging plays and what risk is associated and the potential outcomes for different stakeholders across the industry. And what I mean by that is, some people just think that the traders are the green coffee traders are the only ones that should be hedging. But producers can hedge, roasters can hedge, anyone can hedge in this whole supply chain. And in fact, it's probably a good idea for more people to be thinking about hedging in the coffee industry if they understand what's happening. So Carley, tell us about hedging. What is it, first of all?
Sure. So I'll start by saying the futures markets were literally created to shift price risk from producers and end users to speculators. So this is the whole purpose of the futures markets. Now, most people are speculating and gambling or doing whatever you want to call it. That's what most people are doing. But the purpose of all of this chaos is so that somebody that's producing coffee or corn or whatever it is can come to these markets and put together some sort of strategy to either eliminate or reduce their price risk. So that's the goal of hedging. Hedging is a lot like insurance. You're just trying to protect yourself from something bad happening. You're not guaranteeing the outcome is going to be exactly perfect. Hedging is fuzzy math, especially if you're dealing with something like a commodity like coffee. What the coffee futures market does might not exactly match the local market that you're trading in. So it's not exactly penny for penny, and it never will be. So you have to understand it's not black and white, it's gray. But my personal take on it is anytime prices are relatively favorable for you or your operation, you should be at least partially hedged, but maybe even aggressively hedged. So like, for example, coffee right now is around 250 at the time of this recording, 230,
230 today.
We'll just, yeah. We've only been above 260 6 times in the last 50 years. So when I look at that, I say the odds are, even though I'm bullish coffee, long run, short run, the odds are these are really good prices. As a producer, you don't want to be a bag holder. You don't want to be left trying to sell your coffee at $1 when you could have sold it at $2.50. So you can put together strategies that basically either lock in your price or at least put an insurance policy beneath the market. There's two major forms. When most people hedge, what they do is they just sell a futures contract. So if you have like 37,000, I'm just going to roughly 37,000 pounds of coffee to sell, you could sell one futures contract at 230. You basically locked in your price. So as the futures market goes up, you're losing in the futures market, making in the cash. As the cash market, if coffee goes down, you're losing in the futures, making in the futures, losing your cash. So basically you've locked in your price. You don't care if coffee goes up or down, because on one hand, you're always making, on one hand, you're always losing. That's a perfect hedge, or at least as perfect as you can get if you ignore the discrepancies between the futures and the local cash market. That's a pure hedge. I'm not generally a fan of doing it that way unless we're talking maybe if coffee gets to like 300, 330, then it's probably worthwhile to be that aggressive of a hedger. In the meantime, what we help our clients do is it's a strategy called risk reversals.
Mm-hmm.
And what that means is we want the market, if we're a producer, we want the market to go up because that's how we make more money. If it's going to go up, we don't want to be in its way. And so with a risk reversal, what you can do is you can sell a call option. Now, this gets a little bit complicated. I'm going to try to keep it simple.
Mm-hmm.
You can sell a call option. Let's say I looked at the December options before I got on. So if you wanted to hedge for the next 90-ish days, basically get you through the harvest lows, you could sell a 260 call and use the proceeds to buy a 220 put. So it's free insurance. Let me backtrack a little bit.
Yep.
A lot of people like to just buy put options, which is basically an insurance policy against coffee going below a certain price. So if you bought a 220 put and coffee continues higher, your put just expires worthless. You wasted money on that insurance, but you had insurance and you could sleep well at night.
Mm-hmm.
If coffee goes down below 220, you've locked in your price at 220. So even if coffee goes to zero, your put option is going to pay off anything that you're losing on the price in the cash market. That sounds like a wonderful idea, but the problem is those puts are really, really expensive. So instead of spending $3,000 or $4,000 on a put that might expire worthless or might pay out, you can use the market's money, and that's why we sell the call options. By selling the call option, we're bringing in money from the market, mm-hmm. and we're using it to buy our insurance. So it's free insurance. When I say free, I'm talking about the cash outlay. You're selling one option for $4,000, you're buying one for $4,000. It doesn't cost you any money. But if the price of coffee goes above your short call strike price, so 260 in this example, your cash market will continue to gain, but you're losing in the option trade. So your option's eating up any benefit you get above 260. But in my opinion, you're giving yourself 30 cents extra for the next 3 months in additional appreciation power, and you have a floor at 220. You can't really hedge much better than that, to be honest. Mm. If you said, I don't want anything getting in the way, if coffee's going to 300, I want to be there for the whole thing, you can do that, but you're basically cash market speculating or cash market gambling. And if you buy the put options and and not sell the call, you just spend your own money on the insurance mm-hmm. policy and follow the market up, you're going to shave a huge piece of your profit margin off of the bottom line. Because just imagine if you spent $4,000 or $5,000 every 2 or 3 months to buy puts and coffee keeps going up. Obviously, you're making money on the other hand, but that's a lot of money to be just thrown away.
Gambling with.
Yeah, gambling. Yeah. So suddenly your hedge that's supposed to protect you is almost like a gamble. You're right. So, and it's tricky because what is appropriate in the market conditions can change very dramatically. If coffee was $1, it would not make sense to buy. It would not make sense to sell calls. If coffee's at $1, we can expect at some point we're probably going to move quite a bit higher. You don't want anything to be in the way. You don't want to be picking up pennies in front of the steamroller. Mm-hmm. So if coffee's $1, maybe the best strategy is just catastrophic puts. Buy some puts underneath the market just in case all heck breaks loose, and then let the market do what it wants to do. So every situation is a little different, and that's what makes it difficult and hard for people to comprehend, which is why, as you mentioned earlier, if you are going to hedge, make sure you're talking to someone, even if it's not me. Talk to someone. Don't open like a brokerage account and just start slinging contracts, because that can really get dangerous very quickly.
And expensive, right? Like this is not something where you're just like buying this is thousands of dollars in order to get involved in this, right?
Yeah, and coffee moves very, very quickly. I mean, just on Friday, coffee was down 9-10 cents. That's almost $4,000 for one single contract. So if you make a mistake or you're not doing exactly what you're supposed to be doing, it can be very, very expensive. When your goal was to reduce your risk, you actually are adding risk to your portfolio.
When I first started learning about futures contracts, there was this example that was used about, like, there's 2 containers of coffee, right?
Mm-hmm.
So a farmer knows he's going to oversimplify it for those who have no idea what the fuck we're talking about. If a producer knows he can create 2 containers of coffee, and he knows that he has to make this much money in order to keep his farm running and have enough to keep his wages going, right?
Mm-hmm.
If a coffee company comes to him and says, we want half your harvest for this much money, and he knows that that's not going to be enough. So he sells 1 container in the cash market and then uses the other half of the container and hedges it on the futures market and goes for a higher price, right? Is that the oversimplistic way of looking at hedging?
Or
is that
oversimplistic? It's, I mean,
fix that analogy for me then.
Okay. So it's all right. So I think if I understand you correctly, he had 2 buckets and he sold one in the cash market and then he sold futures for the other one.
Right, like to cover the cost of what his losses were in the first container that he sold. So he sold it below the cost of what he was expecting, and the other container, he's going to send it to the futures market at a higher price. But does that require him? Does that require him to sell, to make sure that on the other side of that there has to be a buyer for that contract at a higher price to make up for the losses that he made on the first container?
Yeah. If I'm understanding that correctly, he's basically trying to re-own, so that if prices go up, he can hopefully do better on that. I mean that also too is a little bit of gambling. So I'll say this: a farmer has, like, let's say he has whatever 100,000 bushels of corn, whatever it is. You don't have to hedge all 100,000 or none. You can hedge 20, 30, 40, 50, and do it incrementally. And that's how we encourage our clients to do it, because in the end, we want them to be able to get as much money as they can for their crop. We're just trying to protect them in case something goes wrong. So if prices are really high, we might be hedging 100% of that crop. If prices are low, we might only be hedging 10 or 20%. Now that's a strategy. Some people will always we have some clients that always hedge 100% no matter what. They don't want any price risk. They know what they need to make money. They need exactly this price, and they literally just are
whatever the difference is from what they're selling it at, that's what they're going to hedge it.
They constantly just always short futures, and just roll it. And to be honest, the markets are the way they're designed. Like if you look at futures, usually the front month. So let's say, just hypothetically, the July contract is usually trading at a discount to the September. The September's at a discount to December. So if you're a hedger and you always have a futures hedge on, you're always short the futures. If you have a ton of money and you don't have to worry about margin calls and that sort of thing, that doesn't stress you out, that's the way to go, because it's called contango. But basically, the market you'll always kind of benefit from the fact that the distant contract is higher, and as we get closer to expiration, even if the price of coffee or whatever it is you're working with stays exactly the same, the back months have to come in line to the front month or the cash market. So it's kind of built into the market for producers to hedge really nicely that way. And it works against speculators and for hedgers. So that's something to keep in mind when we badmouth speculators. But there's, again, you really want to use common sense. So common sense tells us we look at seasonality, we look at where speculators are positioned, we look at what the history of coffee prices are, and we use that to dictate how much we should hedge and how little we should hedge, and proceed accordingly. And that doesn't mean we're right. That doesn't mean all of the analysis and all the smart people in the room aren't going to be able to figure out where coffee's going, but you have to basically play the odds.
I need to throw a spanner into the works here, because this is a real life situation that everybody's faced with: currency and the role that different currencies play in this scenario. So coffee producers are selling the coffee mostly in countries that USD is not their
Mm-hmm.
currency, and people are buying coffee that is usually other than obviously in the US, but they're buying coffee in a currency that is not in their native currency. Where does that come into all of this?
Okay, this is a really great question. So in the case of coffee producers, most of those countries have currencies that are not listed on the futures exchange.
Mm-hmm.
They're in spot forex. You could probably use spot forex to hedge. That opens a can of worms to talk about that, so I'm not going to get too deep into it. But it's not super easy to hedge those smaller, not the big five currencies.
Mm-hmm.
That said, you can hedge with the ICE exchange actually has a dollar index futures contract. It's a product if you're doing enough size and your currency risk is enough, like let's say roughly $100,000 represents $1 index futures contract. So if you do need to hedge that much currency, you could do it there. So again, it's the same idea. If the dollar is really cheap, you probably don't want to hedge you do want to hedge. If it's really expensive, maybe you don't, but you could use that for hedging purposes in currencies, but it gets a little bit complicated. So currency risk is going to be a big problem always, no matter what. And another thing that we didn't mention, which is a little easier to hedge if the farming operation has a lot of energy expense. So like gasoline or heating oil or whatever it is they're using to fuel their machinery or whatever. You can hedge that in the futures markets also, and the exchange has listed micro contracts, which are very, very small. So it even allows like a small farming operation. Let's say one day crude oil drops to $30. Mm-hmm. If crude's at $20, $30, that's probably a good idea for even the smallest family operation that has fuel costs every month to buy a micro futures contract and that way hedge their price risk. So you can even hedge fuel risk. Unfortunately, currency risk is a little more complicated just because there's liquidity issues if we're dealing with the exotic currencies is what they call them. So
the exotic currencies, yeah, I love
exotics.
that. So if a coffee producer is using hedging, how is and they're selling, how is hedging useful for someone who buys coffee?
Okay, it's a lot more difficult as a commodity buyer to hedge your price risk than it is a producer. And the reason I'm going to say this is why. For a producer, we just offered the idea of selling a call option and buying a put option. It works really beautifully for producers. You can do the opposite for a buyer. You can sell a put option and use the proceeds to buy call options. But the problem is the market is skewed because I already said commodities generally go down more than they go up, but the thing is they go up faster than they go down. When commodities go up, it's wild. We get crazy explosions higher, and the downswings are usually dribbles, and the option market knows that. So the option market's priced accordingly. So if you're selling a put to buy a call, the math's not going to be nearly as attractive as it would be for a producer doing the opposite. But you can do it. You're probably just looking at tighter spreads. So like you're not going to be able to give yourself as much cushion on markets moving favorably, but you can get a foot in the door. And also at this particular juncture, it's a really, really great time for producers to be hedging. Buyers probably should have a catastrophic insurance in place, but it's not the best time to be hedging the upside because you've already seen a big explosion on the upside. And
wow.
Even if coffee, even though we think coffee might go higher in the long run, history tells us that at some point this rally will have some sort of last hurrah and it's going to go down, and it probably goes down to $1 or so. I know that's hard to hear, but that's just the reality. And I know there's a lot of supply issues, but the demand side of the equation is never guaranteed. And so we just have to expect that eventually the commodity cycle of boom and bust will apply to coffee. It always has, and eventually it will. So,
okay. So, folks, now if you've heard all of that and you've realized that hedging is something that you shouldn't do on your own and that you should get a professional involved, Tune into the next episode because we're going to talk about some of the process involved in hedging and what you need to go through, whether you are a producer or you are a roaster and you're looking to hedge. We're going to talk with Carley about what that looks like for you. How do you approach that? And what do you need to turn up to a meeting with somebody like Carley and start the process of hedging, because it's something that I think more and more people need to think about, and a lot of people don't. So join us for the next episode. Peace, love, and peanut butter. Have an amazing rest of your day. I really hope you enjoyed this episode, friends. Please don't forget to show us some love by subscribing, liking, commenting, and most of all, sharing this podcast with your friends. Check the show notes for links, including our sponsors and our Patreon. And stay tuned for more great conversations on the Daily Coffee Pro by Map It Forward.